Hello and welcome to about an hour of robust business conversations on Business Morning. And it's coming to you live here on Channels Television. I'm Ini John Mekwa. Let's do this together. Well, one of the current business issues in Nigeria now is JP Morgan delisting Nigeria from the emerging market. The U.S. Investment Bank is citing what it calls government's failure to take advantage of high oil prices. A report released by the multinational financial institution mentions that the country has failed to take advantage of high oil prices, adding that the Nigerian National Petroleum Company did not transfer any revenue to the government from January to March this year. That's because of petrol subsidy and low oil production. The report shows that Nigeria was replaced on the list with Serbia due to the country's high reserves and a fiscally cautious government, and also Uzbekistan, which is relatively low debt despite Russian exposure. Well, we have the Chief Executive Officer of Center for the Promotion of Private Enterprise, Dr. Muda Yusuf, to speak to this now and tell us some of the implications of this action by JP Morgan. Good morning, Dr. Yusuf. Thank you so much for joining us.
Good morning. Good morning.
Great. So, Dr. Yusuf, what does this mean, delisting Nigeria from emerging market sovereign recommendations? What does it mean, really?
Well, I think it's about a reclassification of Nigeria within the context of credit risk rating. Because JP Morgan is like an investment advisory firm, and their index shows a rating of the performance or the credit rating of each of the bonds, especially from emerging markets, whether it is sovereign bond or corporate bond. And the issue here is that Nigeria is a paradox. A paradox because we are an oil-producing country, and at a time like this, we should be reaping a whole lot from the windfall in oil price. But the paradox is that we are not able to do that. Rather than improve our fiscal position, the high oil price is further weakening our fiscal position. Now we are dealing with a subsidy of about $9 billion US. We have a debt service, planned debt service of about $8 billion US, out of a total revenue projected at about $20 billion US. So you can see how weak the fiscal position is. So what the index is showing us from JP Morgan is like a red flag. It's not that people will not invest in our bonds, whether corporate or sovereign. It's just to create an awareness of the level of risk. So this, our own investment now will attract investors, first, that have high appetite for risk. Secondly, it has implications for the cost of borrowing externally, either by corporates or by sovereign, in terms of the interest we'll have to pay on our bonds. So these are the implications. And all of these things are also consequences of the general macroeconomic condition. There are consequences of the challenges we have had with reforming our oil and gas sector, particularly from the point of view of the oil subsidy. And of course, the challenges around the oil theft. So these are the things. It's just a reflection of the fiscal position of governments and implication for credit rating.
So one of the concerns of JP Morgan is the intention for Eurobond, the sale of Eurobond worth $950 million. And this is coming just less than 2 months after the country raised $1.25 billion. That was in March at the cost of 8.37%. So you talked about debt servicing. You talked about the cost of borrowing that this will mean to the country. So if 2 months ago we had it at 8.75 or 73, then I wonder at what cost we are going to get this $920 billion that the country intends to go for again.
Well, the implication is that the cost will be higher, because we need to, there has to be a risk premium. Because of the fiscal position of government as a result of these issues that I've mentioned, the risk of investing will be high. And when the risk is higher, the cost of borrowing will be higher. So there has to be a risk premium. And that will mean that even now we are talking about a debt service of close to 8 billion US dollars. That means that the debt service burden is going to increase, because given the revenue profile and the expenditure profile that we have, we are likely to see a lot more borrowing, both domestically and externally. And with this, the prevailing fiscal condition, that means that the cost of borrowing will increase. And the implication is that the debt burden is also likely to be elevated as we go forward. And unfortunately, we are not likely to see any major reforms between now and the 2023 elections because of the political dimension of the reforms, particularly around oil and gas sector. So we may have to go through this between now and the 2023 elections. So the macroeconomic implications will be very, very profound, both from the point of view of the borrowing, the debt service, the inflationary implication, and even possibly the exchange rate situation. It's going to be very, very challenging from a macroeconomic point of view.
All right, Dr. Muda Yusuf, CEO, CPPE, thank you so much for elaborating on that delisting issue. This is obviously the beginning of a conversation, and I know that we'll take it further in the nearest future. Thank you so much.
Thank you very much.
Well, in another development, the chairman of Major Oil Marketers Association of Nigeria, MOMAN, Mr. Olumide Adeosun, has been reacting to the resolution that airline operators should begin the process of securing a license for the importation of aviation fuel. Mr. Adeosun believes that a lasting solution would be that airlines never enter into long-term contracts with oil marketers.
The way that the airlines in Nigeria have bought fuel was always unsustainable, because it really depended on aviation fuel being at a very specific price. You have an ecosystem where we have major oil marketers and you have other bulk breakers who, as a matter of routine, bring oil in as part of their core business, including jet fuel. Jet fuel is probably the most needy or the most demanding of all the products we import as well. So I'd be quite interested to understand the ecosystem that the airline operators of Nigeria have in place to be able to deal with the demands of importing fuel, which is not their core business. I can't think of any international airline worldwide that has entered into that sort of operation before. I've seen deals like the Marathon deal with Delta in the US, where Delta bought into a refinery so that they could guarantee their offtake and secure the pricing. But I'll be curious to see how the airline operators of Nigeria intend to manage that alongside their core business, because they're two completely separate businesses that require very separate skills.
The World Bank has advised Nigeria and other African countries to focus on digital development, as too many of Africa's expanding youth population will be denied the opportunity to live up to their potential with the current incremental pace of economic and social advancement. Digital technologies offer an opportunity to unlock new pathways for rapid economic growth, innovation, job creation, and access to services that would have been unimaginable only a decade ago. Well, we want to take that digital conversation to the micro, small, and medium enterprises, and we're doing that with Enoika, founder, Business Analysis School, joining us from Canada. Hi, Eno, good morning. Good morning, Eno.
Hi, Eni. Good morning.
Great.
Good morning, Eni. How are you doing this morning?
Doing good. Looking bright, I must say. Thanks so much for joining us this morning.
For sure. Happy to be back.
Great, great. So you are a business owner. You are in that group where we call the MSMEs, and you're also a consultant. Yes. So tell us, from your experience in recent times, how much have business owners and operators been leveraging technology in their operations, in their marketing, in even in their production. How much have you seen technology in that space?
For sure. Ini, what I have seen with regards to technology, especially in the past 2 years after the pandemic, is that a lot of businesses have had to leverage technology, go online, move out of their brick and mortar stores and find ways to connect with their customers online. So leveraging technology through digital marketing, through digital transformation, implementing technology softwares that would help them to serve customers faster, better, increase production, and of course, increase service times are things that we have seen businesses implement to actually reach their customers. Even as a business owner myself, I have had to implement more technologies, hire IT consultants, and also work with other consultants in other industries to see how we could partner. For example, leveraging social media has been a big conversation with regards to small and medium businesses leveraging technology, being able to use social media to communicate with our customers, being able to leverage cloud technology, being able to leverage online digital marketing services. We've been able to also reach other countries with our services.
Yeah, interesting that you say you had to hire, the IT or ICT experts, because I'm just curious. These are skills or knowledge that needs to be acquired, and nobody really saw it coming. Nobody saw COVID coming. COVID came and pushed itself on the world, and everybody had to look for ways. So how receptive have business owners and operators been in acquiring this ICT knowledge, or do people basically hire, the skills or, the personnel for that?
It's really been two ways. One, hiring for sure. With remote working, we have seen that we're able to hire employees even outside of our local areas. So, for example, with our business, we actually have a global remote team. So we have staff in Africa, we have staff in North America. They are able to carry out their functions remotely. So because of that, we're able to hire consultants in any area of the business. And we see that also with a lot of small businesses being able to hire remotely. And of course, being able to increase their reach. Also, with regards to technology and ICT knowledge, a lot of businesses have also incorporated technology training for their clients. We've seen companies who have reached out and said, would like to train our staff on how to use these technologies. And also because they're very new, a lot of companies didn't plan for this. So learning how to leverage technology has been important, but we can also see how it has made companies more productive. For example, automation, right? Robotic process automation, which is, becoming a very popular trend right now with small and medium businesses, teaching staff how to actually automate the mundane and monotonous processes that they carry out day to day has left staff happy, more productive, because they can focus on the creative side of the business and, of course, help increase revenue.
I hope it hasn't left staff unemployed.
No, definitely not. Definitely not. What we see happen is that with robotic process automation, we have this bot carrying out the, mundane and, monotonous tasks that people are not happy to do: data collection, data entry, things that, copy and pasting or moving data files. These are things that are not actually they're not creative roles, right? So what happens is people can focus on more creative roles, find ways to actually improve on the strategy, do better, brainstorming, and of course, find ways to actually implement their, the processes and find ways to even enter new markets, which is what we've seen in the last 2 years, is that it's a global playing field for everyone. You can live in Lagos, Nigeria, and sell your goods and services to someone in another country based on, technology.
What about the cost of this technology for small businesses, funding has always been a major challenge. So, this is incurring extra costs, albeit, it does have the potential to improve their revenue. But, at first you have to deal with that cost.
Exactly. So as a small or medium business owner, cost is the first thing you think about when you're trying to implement solutions and technology. And to be honest, Ini, before now, a lot of these technology solutions were actually only being used by the very big companies. For example, AI, artificial intelligence, or even automation tools, or cybersecurity and cloud management tools. But what we have seen is that there have been a lot of startups, a lot of technology startups who have provided a lot of these services on a pay-as-you-go platform, whereby you pay for what you use. Therefore, small businesses like ours are able to actually pay for only what we use on a monthly recurring subscription model. And that helps us to keep our costs low, and they're actually more affordable than you think. And of course, when you look at the benefits of implementing technologies like AI, for example, you're able to do a lot of predictive analysis. You're able to understand customer behavior, understand trends with your customers, know your peak times, your peak hours. You're able to actually target the right customers based on demographics, psychographics. All of these things would help, of course, to serve your customers better, increase revenue, and of course, improve your customer experience. And at the end of the day, what we can see is that this has really helped businesses to not only increase revenue, but also to keep customers happy and satisfied.
All right. And then you mentioned the issue of marketing and social media, earlier. Now, in Nigeria, there's the new taxing of social media. How has that affected the use of social media for marketing and operations?
Honestly, it has really not affected the use of social media, despite the taxes, because what we see is that a lot of business owners who really understand how to use social media and are leveraging the right technology solution are able to get huge returns on the spend that they carry out with their marketing campaigns. Also, what we have seen is that businesses have also been able to adopt, better strategies with regards to digital marketing. So we don't always have to depend on paid advertising, because organic marketing still works, right? Having conversations with your customers, asking them questions, carrying out events, or providing some free services or free consultations, and of course, carrying out referral programs. So we've seen businesses also become more creative in ways that they attract and retain their customers. And regardless of the taxes, what businesses have done also is to include those expenses into their costs.
So we, the consumers, pay for it. That's not fair.
Well, I mean that happens. And businesses have to find ways to stay profitable. But we still see that regardless of the taxes, businesses are still leveraging the online space because it's so huge and there's so many opportunities there.
All right. Thank you so much, Enoika, founder, Business Analysis School, for sharing your thoughts with us. We'll certainly have you again on the show in no distance time. Enjoy the rest of your day.
Thank you so much, Ini. It was nice chatting with you. Have a wonderful rest of the morning.
Thank you so much.
Bye.
Bye-bye. So we'll take a break now to conclude this discussion. We have another one going to FX Commodities Market. That's after the break. This is Business Morning on Channels Television. You're welcome back. You're still watching Business Morning here on Channels Television. FX time now, week on week. Volume on the FX Commodities Exchange gained almost 39%. Well, we have joining us to tell us more, give us more details about the markets for the week ended. David Ibidakbo is head marketing, data and research with FX. He joins us from our Abuja studio. Hi, David. Good morning.
Hi, Hini. Good morning.
Great. So let's know what happened in the week that just ended.
Okay, thank you, Ini. So for the duration, May 3rd to May 9th, right, we saw increased activities on the exchange. Just like you said, volumes traded on the exchange spiked by 39% to 3.8 million contracts that were closed on the exchange. When you consider it to compared to 2.7 million contracts that were traded on the exchange, and this was valued at 95 million naira, which is up 5 times compared to 17 million that was traded in the previous day. The number of deals dipped by 7% to 416 deals, which were settled compared to 452 deals. And for our benchmark index, the ACI, we saw a marginal increase by 0.20%. To 472.47 index points. Then the AEI, we saw a marginal decline by 2.75% and closing the week at 198.46 index points. For volumes traded on the exchange across commodities, we saw that maize and paddy rice accounted for over 90% of total volume traded on the exchange for the period under review. Maize, we saw about 1.5 million contracts settled on maize and 1.5 million contracts settled on paddy rice. For the week, it was a bearish trend for investors exposed to more of grain commodities, as we saw only cocoa top the gainers chart for the week. Cocoa increased by 0.17%, making 2 naira gain, closing at 1,244 naira per contract. However, maize, we saw a 12% decline in the price of maize and closed the week by at 217 naira 77 kobo. Soybean declined by 6% to close the week at 403 naira per contract. Sorghum closed the week losing 29.34 naira, which represented an 11% decline week on week. We saw cashew decline by 9%, losing 75 naira, closing the week at 684.31%. Paddy rice also saw a marginal decline by 0.03%, closing the week at 252 naira 79 kobo. Ginger and sesame remained flat, however.
All right, David, and then as you would normally say, if investors or potential investors are interested, they can go to your website.
Yeah, to our website at www.africanexchange.com. And if you want to start trading in the commodity space, you can download our COMEX app, which is available on iOS device and on Android device.
All right, thank you so much. But before I let you go, David, we've been talking about what Nigerians are doing as alternative to wheat, seeing that the war in Ukraine has, blocked the supply of most grain and wheat being used for a whole lot of things. A lot of things has witnessed a skyrocketing hike in its price. What are Nigerians doing? Where are they looking out to for alternative to wheat?
Yeah, thanks, Sini, for that question. So typically, we've seen the price of wheat increase by over 40%, and I would say 44% since the start of the crisis and in February, right? It has been with adverse effect on many African countries, especially Nigeria, that depend largely on import of wheat, right? And so what we are typically seeing consumers do is to shift demand to other alternatives, cheaper alternatives that have little or low exposure to global trade disruptions and global inflation, right? Like rice, corn, sorghum, and the rest, right? And we're also seeing African producers, food producers, also ditch the wheat, right, and shift to other alternative products or commodities that could also bring out this end product, right, during the course of the crisis. However, in the Nigerian market, especially in the open market, we've not really seen that effect of the crisis on the price of commodities, and I would largely say that this is because of the absence of large players in the open market currently, right? So that factor has kind of weighed, and so we've seen just a very minimal effect on the prices of commodities during the same period, right? But however, so if you take a look at what the outlook is between now and probably come harvest, right? We are going to see, we will start seeing that effect, right? Because typically we are seeing a shift in demand to other commodities that are close substitute to wheat, especially corn, rice, and we should typically start seeing that reflect on the price of these commodities going forward.
Yeah, David, thank you. Although some Nigerians will tell you, man, we have not seen minimal increase in the price of commodities. I mean, bread is about 100% more than it was about this time last year. So it's been there. But thank you so much for sharing your thoughts with us this morning. We're still staying with AFEX now.
Thank you very much.
Still staying with AFEX now, we'll have Michael Martins also joining us from Abuja, and he's here to tell us about the rapid expansion of fintech companies in Nigeria, which has been fueled by increased digitization of financial services, cheap operational costs, and a strong regulatory focus on financial inclusion outside traditional banking sector. In digital financial services, financial inclusion and payment mechanism are key considerations. Now, let's put the smallholder farmers into this picture now. Talking about commodities, we have to find out how we digitalize their operations. And so we have Michael Martins. Hi, Michael. Good morning.
Hi, Ine. Good morning. It is always a pleasure to be here.
Good to have you, Michael. So what are some primary difficulties facing Nigeria's agri sector in terms of access to finance that digital financial services can address?
Thanks a lot, Ini, for that question. And I think it's very important, to talk about. So if you look at Nigeria's digital economy, I think it's a bit of a whoopsie-daisy surprise that much of the growth and development that has occurred over the past decade, hasn't transferred to the agricultural sector. One of the major challenges that we have faced in that regard, particularly with regards to access to finance, is the fact that if you look at the investment or the loan landscape today, it's currently a high interest rate environment, right? So the MPR is currently, has historically been around 13.5 to 14%. And if you want to get loans at the bank, it's usually significantly higher than 20%. And you have to imagine that for the average smallholder farmer with very little visibility and very little in the way of collateral too, their interest rate is going to be significantly higher than that. So they tend to not even go for that. In addition to that, you also have issues with collateral, right? So historically, commodities have not been recognized as good enough collateral, for commercial banks and also even some private entities, right? In comparison to other industries like the oil and gas industry, whereby certain fixed assets can be used as collateral for loans, that is not currently at scale in the agricultural sector. Even with the development of the e-warehouse receipt system, it has mostly been, largely useful for processors, and we haven't, at scale solved how we can use the same for smallholder farmers. If you look historically too, right, with regards to commercial banks and commercial entities generally, capital allocation to the agricultural sector has been significantly less than 5%, right? And whether that's due to data issue or low visibility, there are a lot of issues to address in that regard. But lastly, but certainly not least, with regards to the challenges, I think it's safe to say that even if the digital, financial services were to be available, it's not the case that, the smallholder farmers that need them are educated enough, to be able to take advantage of them. So there is a high, illiteracy level among smallholder farmer communities, which also does need to be addressed before we can then begin to, which are some of the problems that we then think, digital financial services maybe can, start addressing.
Yeah, and we just ended April, which was a financial literacy month. So I do hope someone can take that advantage of that. But how critical is it that digital financial services are integrated with other digital services offered in the agricultural sector?
Thank you very much. I think it's significantly critical, right? To be able to have that integration across board, for different digital services that are being offered to smallholder farmers. It's also our guiding principle here, at Apex Commodities Exchange. So one of the things that we've tried to do since its inception is to create different digital apps that solve different solutions, or that prefer different solutions to smallholder farmers. So as of today, we have Workbench, which is essentially an inventory management system for smallholder farmers, which gives you full visibility over the quality and quantity of the commodities that you have, under your purview. It's also important for data and also for visibility of the farmlands generally. In addition to that, we also have COMEX, right, which is essentially a trade app that provides access to market and also access to loans for smallholder farmers. So it's the case that if the average smallholder farmer today wants to trade, he can do that from the comfort of his, he can do that from the comfort of his phone or digital device. In addition to that, you also have weather, and other digital services. We can essentially also help predict, what will happen in any given commodity season. And of course, last but certainly not least, you also have AI and machine learning, which can also help you predict the credit worthiness, right, of the average smallholder farmer, which can significantly improve, which would significantly improve against the risk of default, right? So layering all these services together to provide one integrated solution to smallholder farmers, I think is incredibly important. What you want to create, at the end of the day, is a bit of, we would like to say, an Amazon or an Alibaba for smallholder farmers, which is essentially a place where you can go and get access to as many digital financial services or digital services, as possible.
Yeah, and since we're on that, smallholder farmers, they must be encouraged to use digital financial services by both the public and the private sectors. What kind of policy direction do you think and private sector roles can help boost this?
Thanks a lot for that question. So I think in terms of, the collaboration between the public and private sector, I think there's a whole lot of work that needs to be done between now and the next couple of years. The most important of which, the role that we see the public sector playing, over the next couple of years would essentially be, with regards to infrastructure, right? So with regards to digital services, there are certain infrastructure that are critical, to its adoption. The first of which, of course, would be electricity. People need, access to electricity to charge their phones so that they can have access to digital services. There's also internet connectivity, which is also another layer, another element which is particularly important in getting access, right, to digital services. Last but certainly not least would also be market education, which is basically educating smallholder farmers on, the plethora of different digital services that are available to them, per time. With regards to the private sector, I think mostly if it's with regards to product design. So as of today, most of the digital services that are being offered in the agricultural sector are being offered by private entities. And we do see them playing the role whereby they design products that are, intuitive enough for somebody, with the least amount of education to use. And it's also important to be able to layer on, alternative digital services. One of the key examples would, of course, be the USSD. So much in the same way we today, can recharge on our phones, have access to, loans on our phones by using USSD. We think that, for the private sector, we can also layer on, that type of infrastructure or that type of service or that type of element, to provide, digital services to smallholder farmers.
All right, Michael Martins, Portfolio Manager at Apex. Thank you so much for sharing your thoughts with us. Let's do it again next week, Wednesday. Enjoy the rest of your day.
You're welcome, Minu.
Welcome back. We head straight to the markets now with Will Ibong, and Will doesn't have that much smile on her face because that prediction has come to pass.
It's not, like you say, it's not every day is not Christmas. So
now every day is not Christmas.
Yeah, it's not Christmas. So we know that investors.
I saw you on the stock market report last night saying, nothing goes up forever.
Yeah,
I was like, Will
forever.
is beginning to understand the reality now.
The market is, very versatile, and the vicissitude of the market cannot be predicted. It's very unpredictable. It goes up, it goes down. So we just have to, follow that cycle. That's it.
Exactly. It's just a cycle.
We just have to follow that market, and then we just had a very good run, 18 days straight, without a bearish trend. That's really good for the market. We saw profit taking MTN Nigeria was the biggest culprit, down about 3.6% yesterday, and that dragged the all-share index by 0.19%. And the all-share index is currently at 51,805.41 points, still within the 51,000 level. We are hoping it stays that way. Month-to-date gains are still at 4.4%, still high enough, and the year-to-date gain 21.3%, super level for the market, and super for investors. If they're interested in coming to the market, this is a great time for them to invest in Nigerian equities. Now, the total volume of trades traded yesterday, we saw 331.52 million units transacted, valued at 5.03 billion naira, and in over 6,000 deals. Deals was a sea of red yesterday. It was a bloodbath, but it didn't. It's just a mild, pullback, and we're hoping that today we get a rebound. Investors are probably just going to be, very excited to come and buy maybe low-level stocks now. The stocks that have been, the value has gone down, and it's a good time to enter the market. Now, GT Co was the most traded stock yesterday. It was up 51.96 million units. Was traded yesterday. We saw Transcorp following, and First Bank, FBN Holdings followed that. Sectoral performance, we saw the banking index down yesterday. Zenith Bank and UBA were the major pullbacks in that counter. We saw consumer goods was up. PZ, Unilever, Okomu Oil, and PZ was up yesterday. The three stocks were really the ones that actually pulled the consumer goods index. Lafarge was the one that helped the industrial goods counter, and insurance goods, we saw Actamat and Coronation Insurance. Oil and gas, we had O&O doing their thing there. So we'll move quickly to the fixed income space, where we saw a bit of a mixed performance for the bonds segment. It was really not... It was on a mixed note. We have pockets of demand for short to mid-dated maturities. Average yield rose by 5 basis points, especially for the July 2034 paper there. So 4 deals transacted there. For the Treasury bills market was also a bit quiet. Demand for short-dated maturities was on the back of this, positive system liquidity. Average yield closed flat. But we have Caleb Alimi, fixed income dealer at FSDH Merchant Bank, to tell us more about that. But with Caleb, good morning. Are you there, Caleb?
Good morning, Will.
Yes, good morning, Caleb. We've just seen a bit of yesterday's transactions, a bit mixed notes for the fixed income space. But we're looking ahead just for today, what's going to happen. We have the Treasury bills auction. What do you think? What are your expectations?
Largely, we expect the mixed sentiments to continue as we continue to juggle between the best asset allocation between cash and short-dated yields. Market generally expects yields to continue to climb on the back of the borrowing program of the government, rising inflation, and other factors. Today, there is NTB primary auction, like you rightly mentioned. The DMO is floating about 122 billion of the one-year paper. Last stop rate was at 4.75 on that paper. We expect a minimum of about 20 basis points uptick in that. We expect it to close around 4.95. For the 91 days and the 182 days, we expect those ones to close flat. We haven't seen much interaction or more difference or more change in that aspect of the curve. So we expect that to maintain, at 1.74 and 3.20%. The big fish is the one-year paper, where we expect an uptick in yield of at least 20 basis points.
So already we're seeing, I think there was an uptick in the yields for the secondary market. Do you want to talk about that a bit? I think I noticed some uptick in that counter.
Yes, we also continue to experience an uptick for treasury bills and for bonds, largely because of the expectations of higher interest rates in the later in the year, especially on the back of tighter system liquidity. So we'll continue to see that in the secondary market. We've seen secondary market yields rise on the one-year paper from around 4.7 to about 4.85%. That's why I think the primary market today, where people go and clear much bigger size, to clear a little higher. So we expect the uptick to continue, both for the treasury bills and for the bond space as well.
Okay, so looking at the Euro bond market, especially with the global rout that's going on, the Euro bonds, I think, is traded on a bearish note. Could you tell us more about what's going on there?
Well, the Euro market has been a bloodbath for most fixed income traders. Okay. And that's largely because of what's going on in the US, rising very, very hot inflation. We expect US inflation data to also come out today. Still expected to be very high at around 8.1%. Last was at 8.5%. Analysts expect about 8.1%, which is still considered very high for them. Earlier in the month, we saw the US Fed increase their benchmark rate by 50 basis points, and the market has continued to react to that. We've seen the 10-year US Treasury hit its highest since 2018 at 3.2% about 2 days ago. We also saw it track downwards about 20 basis points yesterday. We saw market react to that 3.2% peak. And we saw yields in the Nigerian fixed income space, Eurobond space actually react to that. For example, we saw the Nigeria 2049 going as high as 12%. That hasn't happened since COVID, and we've seen other short-dated Nigeria papers, very, very elevated levels. And that's largely in reaction to US 10-year Treasury yields, right?
So this is a time when investors are probably looking at, investing in Forex, foreign exchange, not the Naira. So thank you so much, Caleb Alimi, for the insights on the program. Good to have you. So, Ini, we'll end with the NASD unlisted market. We saw an uptick in that segment. It was up 1.29% yesterday. That's a good one. Inverse relationship with the listed equities stocks on the Nigerian exchange. But volume and value were down yesterday. Only deals were up from 24 traded on Tuesday. So that's what we have.
Yeah, we can't have a bloodbath, in all the markets. There has to be a
good news, ending on a good note.
All right, thank you so much, Will.
Yeah.
And we'll take a break now. When we come back, we'll head to London. This is Business Morning on Channels Television. You're welcome back. You're still watching Business Morning on Channels Television, and it's the day after the Queen's speech in the UK. We have Juliana joining us now to tell us the highlight, especially as it concerns the economy. Good morning, Juliana. What are those things we should be looking out for, looking forward to following that speech?
Good morning, Inni. I think the trouble is there isn't much to look forward to from the Queen's speech. I think it's pretty fair to say that it hasn't gone down too well. I think, first of all, most notably, as we've said repeatedly, it was pretty sad for the British public that, of course, the Queen, the 96-year-old monarch, couldn't deliver the speech. It was instead delivered by her son, the heir to the throne, the Prince of Wales, Prince Charles. And I don't think the delivery went as well as the Queen's poised delivery has done so in the past. There were 38 bills that were mentioned, which is pieces of legislation the government hoped to put through Parliament over the next 12 months. And the cost of living crisis, although it was right up at the top of the discussion, in terms of what the government are going to do to try and tackle this huge issue, rising costs of fuel, rising costs of energy bills, and stagnation of wages, was lacking. There just didn't appear to be anything there. Now, immediately after the Prince of Wales delivered that speech, there was a debate in Parliament, and Sir Keir Starmer was asking about what the government are going to do to try and prevent inflation reaching 10%, which is what was forecast by the Bank of England last week. The Prime Minister did say that we would hear more about what the Chancellor and the Treasury are going to do to try and help beleaguered families. But now, doing the media rounds this morning, the government appeared to be downplaying the statement from the Prime Minister, suggesting that there won't be an emergency budget, that the government have done all they can, and that anybody who's struggling at the moment should go to their local council. It's just not good enough, particularly as if we even look further into 2023, the IMF and the Bank of England too are forecasting the UK to have the slowest growth amongst the G20. So it's just not good enough. Lots of pressure on Chancellor Rishi Sunak's back, and that was pretty apparent if you saw his composure in the House of Commons yesterday.
Yeah, Juliana, pressure on the government, pressure on the people, not very good times in the world at this time. And on top of that, we have to talk about the post-Brexit trade tension between Britain and Northern Ireland, which unfortunately we thought the European Union's proposal will solve, but doesn't look like it will.
Yes, it hasn't been resolved, and we are expecting Liz Truss, the Foreign Secretary, to head to Brussels later this week to try and speak with her EU counterpart to try and resolve the issue of the Northern Ireland Protocol. This is a sticking issue that has haunted three prime ministers before then, including David Cameron and Theresa May. And really, it's all about trying to keep peace and prosperity on the island of Ireland without separating the rest of the United Kingdom from Northern Ireland. Now, the Northern Ireland Protocol was basically made to prevent a border on the island of Ireland. So there is now a border down the Irish Sea. Unionists are not happy with this border. Any goods that are going from the United Kingdom into the island of Ireland has to be checked, which means part of Northern Ireland remains within the EU to prevent this border on the island of Ireland and any friction between both nations. We know that friction between both nations has been completely deadly and murderous in the past. They want to prevent that. Unionists are not happy. Boris Johnson is not happy. He wants to rip the Northern Ireland Protocol out. Of course, that's ripping up the entire withdrawal agreement. EU leaders are really not happy with that. And they said if that does happen, then there could be retaliatory measures in place, including huge import taxes on UK goods going into the EU. It is a huge issue, particularly as if we look at the results of last week's local elections. Sinn Féin, which is a separatist party who do not want the United Kingdom to be together, they won an overwhelming majority of votes from the Unionists. Unionists have said they will not go into some sort of a power-sharing agreement with them if the Northern Ireland Protocol remains in place. This is possibly the most significant challenge that Prime Minister Boris Johnson has had to his leadership. And we know there have been some significant challenges. It is a very, very, very delicate situation. And the Prime Minister believes the only way that this can be done going forward is to rip up the Northern Ireland Agreement. So therefore, there will be no border between the Irish Sea and there will be no border within the island of Ireland. The reason why Europe are not happy with that is because it means there are goods that could be travelling from England perhaps into Ireland, which is Europe, and then end up on the mainland, which means there are no checks in place. It is very complicated. It's taken them several years, so I won't be able to resolve it in several minutes, I'm afraid, Ini, but I will do my best and I'll keep tracking the story.
Yeah, you have certainly done your best, Juliana, but even the explanation we can see is really complicated. You need to paint pictures in your mind to follow that. But well done. Thank you so much. We'll talk to you at 1:30.
Thanks, Ini.
Let's move to another market now. Ladi standing by at the crypto space. Ladi, well, right. you have good company now. Equities has joined the bloodbath. So I mean,
well, it's just one.
If there's any comfort, that is.
If there's any comfort there, but it's just one day. Maybe it might pop back up again. Well, I still have my eyes on that market, though. Not gonna lie. But let's look at the crypto market now. Fair Greed Index is showing 12 points. Remember, yesterday were about 11 points, but it's still extreme fear, but an improvement from yesterday's sentiment. Market cap going down deeper, now below the $1.5 trillion mark. It's down 4% this morning, and we see the volume traded $148.57 billion. That's down about 27%, but we're still seeing major volume on sell-offs this morning. Bitcoin dominance 42.34%, and price of Bitcoin 31,328. We see Bitcoin struggling to hold that 30,000 support at this point. It's down 3.43%. It did test the 29,000 level and did a quick bounce back above 30K. But traders still see more downside and more selling pressure for Bitcoin. Volume traded $53.76 billion. Ethereum there below the $2,500 mark. Well, let's bring in Amari Sachet now, eCash creator, join us live on the show. Great to have you. Good morning.
Hi, great to be here.
Yes, so Amari, we know that XCC is integrating the Avalanche protocol into the XCC network. Tell us what we can expect, from this integration.
Okay, so Avalanche is a second consensus mechanism that we're going to use that is much faster than the traditional Nakamoto ones. What we can expect as a first phase is increased security because reorging blocks is not going to be possible. The 51% attack in the traditional sense is not going to be possible. So we're going to get a lot of benefit from that. And as a second phase that's going to come a bit later, that means instant transactions. So right now in Bitcoin and any derivative of Bitcoin like eCash, when you make a transaction, you have to wait about 10 minutes before the transaction confirms on the network. And we think that it's too long for many use cases, but with Avalanche, we can reduce that to about 2 seconds.
Right, and countdown to May 15th for the upgrade for the eCash network. What can we expect from that?
So after the upgrade, it means that all the nodes on the network are going to be ready to run the new protocol. When it's going to activate exactly, it's going to depend on what many node operators are doing. We need to reach a certain threshold of people using it for it to activate. So that's not 100% over our control, but we can say that we are ready. Like as soon as the ecosystem is ready, we are ready.
Right, so much to unpack there with the network. But, another major issue right now is this UST, a stable coin.
Mm-hmm.
You run into a stable coin because you want to protect your money from either going down, but it stays stable. You want stability. That's why you're running into stable coin. But we're seeing UST now lose that $1 peg. It's down to about 40 cents this morning. How are you seeing this?
Well, that's the trade-off you're making with stable coins, right? Like stable coins are not magic entity that protect against any force in the market, right? They try to equilibrate around the value, but there are still market forces pushing them up and down, and they have mechanism to keep that under control. But once those forces they get bigger than whatever mechanism they have in place to control the price, then we see the value decorrelating very, very quickly and very, very badly, right? So that's the trade-off you are making with a stable coin, is that most of the time it's stable, but when it's not stable, it's really not stable, right? Like you take all the instability at once. So this is a risk that people need to be aware of when they invest in stable coin. This is not the first time we see this kind of event. It hasn't happened in quite some time though. Like it's been a few years since serious decorrelation like that happened. But we've seen that in the past, and we're gonna see that again, right? Because stable coins are just not magic. They are not immune to market forces. They just try to compensate for them as much as they can, but sometimes they cannot.
Quite interesting, and that obviously bring more conversations about regulating stable coins. We're already seen the US start talking about that. All right, Amari Seche, it was great having you on the program. Thank you for coming on.
Thank you.
All right, so looking at the top alts by market cap, it's all red there. BNB is down about 5%. Cardano down 7% at 62 cents. So it's a major sell-off, the correction of global markets and risk assets like Bitcoin and other cryptocurrencies. We're seeing that play out. So it's quite interesting, when stability becomes unstable.
Uncertain.
Yeah, with that stable coin right there.
That's really scary when you see a stable coin,
actually
move.
Lose value because
it says a lot about what's going on in the market.
Yeah, because we know a lot of traders run into stable coins to keep value.
And now you're losing on stable coins.
Quite interesting.
Very interesting times. Thank you so much, Ladi. Well, that's it on the program today. Thank you so much. Do remember that at 1:30. Business Incorporated will be here with more updates from the world of business. Ladi should be here by then. I'll see you tomorrow. I'm Minnie John Mekwa.